Hi, my name is Cashin Nunez, and I'm a financial planner, real estate investor, and mortgage loan originator. And today I'm going to be talking to you about the power of the Thrift Savings Plan, and more specifically, 3 individual funds within the TSP, the S, C, and I. Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Okay, so I have up on my screen the tsp.gov site. I went to fund options, individual funds, and selected the C, S, and I funds. And today we're just going to be discussing the specific details about each one of these funds, the pros, the cons, the good, the bad, and the ugly. I personally love these funds for a bunch of different reasons. It provides diversity. To my mind, the objective of these funds is very clear. And the TSP, in my opinion, does a really good job of not inundating investors with a bunch of superfluous information. It's very easy to get lost in the sauce by going to another bigger brokerage, right? I'm not going to name any names, but they've got all of this data coming at you and all these different options. The TSP doesn't have very many options, but the options that they do have are really good. They come with really low expense ratios. And so I love them for that reason. It gets people involved because you don't feel overwhelmed. And so that analysis paralysis is a little bit less of a barrier when you don't have as many options to invest in. You just choose one and you go. As long as you're not choosing the G fund, right, or the F fund, depending on where you are in terms of taking distributions from your employer-sponsored plan, the TSP, you're going to be good based on some of these returns. But let's jump into it here. So the first thing we're going to start with is the C fund. And I'm going to open that up here and go straight to the performance and risks. So as of December of 2024, the average return, so year-to-date return, is approaching 25%. That's huge, right? The C fund is basically mirroring the performance of the S&P 500 index fund, which is the top 500 companies in the United States by market capitalization. And so the S&P 500 did really well, and as a consequence, the C fund, which is mirroring it, did really well. As you look over the last year, the last 3 years, the last 5 years, those returns are fairly decent as well. The last 3 years, it averages about 9%. The last 5 years, it's averaging 15%. The last 10 years, 13%. And lifetime returns is about 11%. At very few points in the lifespan of this fund has inflation been higher than the return. And at the points where it was higher, the return on this fund wasn't much lower, which is why investing in the stock market is such a great hedge against inflation, and why I highly recommend that people invest more than they save in order to make sure that the purchasing power of your dollar isn't diminished dramatically, okay? But getting back to the explanation of this, you can look, the inception of the C fund was in 1988, and so as we track it from 88 into the 90s, right, the C fund is beating inflation, it's beating inflation. And into the early 2000s, it's continuing to beat inflation, and then it skyrockets as we get into the 2010s, past inflation, and now it's significantly above inflation. $4,000 is the return on $100, and the inflation's eating $266. This is huge, right? The C fund is extremely popular for this reason. The returns are really good. It's an awesome hedge against inflation. What's in the C fund? The composition. So these are some of the sectors that make up the C fund. 8% coming from communication services, 10% coming from consumer discretionaries. Consumer discretionaries are usually like luxury goods, right? Consumer staples are the things that we absolutely need, your food and your gas, things like that. Energy, 4%. Financials, your bigger banks. The C fund is 13% comprised of financials, about 13% comprised of healthcare, So the health insurance industry tends to do really, really well. And 13% of the C fund is comprised of healthcare companies. Industrials sitting at around 9%. Information technology is massive, right? So you've got Facebook or Meta, you've got Microsoft, you've got Nvidia, you've got Apple in this information technology space, Tesla, and they are increasing their market capitalization exponentially these last few years. And so it makes sense that a large portion of the C fund is made up of information technology. And then you have a little bit of real estate, materials, and utilities. So that is the composition of the C fund. Again, what I was saying a little bit earlier, the reason why I love the Thrift Savings Plan, the TSP, is because it's really, really hard to beat these fees. Your net administrative expense ratio is 48 cents for every $1,000 invested. Your investment expense ratio is 0. It's just tracking an index. And then your total expense ratio, as a consequence of the investment expense ratio being zero is 48 cents per $1,000. So if you invest $1,000, it costs you 48 cents to invest that $1,000. Mind you, year to date right now, you're making 25% on that 1,000. Significant, right? In summary, some of the top holdings: Apple, Microsoft, Amazon, Nvidia, the information technology stocks. Berkshire Hathaway, JP Morgan sneak in with the financial sector stocks. Total assets, and this data is about a year ago. This is being recorded in January of 2025. And so this is a little more than a year old, but at the time that they comprised this data, the assets totaled to about $340 billion. The expense ratio was 4.8 basis points, or 0.048%. It's tracking the S&P 500, as I mentioned earlier, and its inception is January of 1988. I really, really, really am a big fan of the C Fund. This video doesn't cover or will not cover in depth the percentage that I recommend people invest into the C Fund, but the C Fund is a significant percentage of my contributions into my thrift savings plan. I don't just do life cycle. I don't just do C Fund or S Fund. There is a combination, but the C Fund is a significant percentage of my contributions to my thrift savings plan for all the reasons explained: the return, what it's tracking, the expense ratio, all the rest. So that's the C Fund. Now let's jump into the S Fund. The S Fund is tracking the Dow Jones index, and it's looking at the small cap stocks, right? So let's jump into the S Fund here and go straight to performance. And we can see here, not as strong. It's not as strong as the C Fund. It still holds its own though, right? Year to date, 17%, not quite 25%. But if you look at the lifetime return, it's 9%, and the lifetime return of the C Fund was about 11%. So it's 2% shy of its nearest individual fund, which is the C Fund. Since inception, you can see here that there are a couple periods in time since 2001. That's when this fund, the S Fund, was started. It dips below inflation, right? Meaning the purchasing power of your dollar is going down and is worth less than how much you're receiving in a return. So there are a couple of times in the history of this fund where that's happening. One I'm noticing is the Great Recession, and the other one seems to be the tech bubble. But once you pull into the 2010s and you move forward, it steadily is beating inflation, right? So that's really good to see. In terms of the composition of the S Fund, the biggest contributions are industrials, information technology still, financials plays a really big part of this fund, healthcare is also a really, really big part, and then consumer discretionary. So there are some luxury goods in there. And that category, I'm willing to bet, is a part of the reason why you see so much fluctuation. Because if you have a large portion of a fund invested in things that we purchase that are discretionary, in tougher times, people decrease the amount of things that they're purchasing, the luxury goods, and so that's going to impact the performance of those companies, and those companies are represented in this fund. 11% of this fund is made up of those companies, and so you're going to have a little bit more dramatic swings, right, as a consequence of this fund being 11% into consumer discretions. All of these things are important to note. When you think about what your objectives are with investing, do you want to invest in something that closely mirrors the overall economy? The C fund, S&P 500, I think is a fairly good representation of where the US economy is from a securities perspective, not speaking to the real estate aspects, the political aspects, and all the rest, just securities. The C fund, which tracks the S&P 500, is a very good representation of where the overall stock market is. If you want to bet that smaller companies are going to rise faster than the more established ones, then the S fund is good for you, right? The Dow is good for you. In terms of fees, the net administrative expense ratio, again, is 48 cents for every $1,000. So that's your overhead costs. The net investment expense ratio is 3.1 basis points or 31 cents of every $1,000 invested. And so the total expense ratio is 79 cents for every $1,000 invested. Still, not a lot of money, all things considered, right? It's more than what you're charged on the C fund, but it's still a really, really low number. So the net administrative expense ratio, again, is 48 cents for every $1,000 that you're investing, same as the C fund. We do have an investment expense ratio here of 31 cents for every $1,000 invested, right? So the total expense ratio is 79 cents for every $1,000 invested. Not as good as the C fund, but still really, really low, all things considered. If we go to the summary, some of the holdings here, the top 10 holdings. Again, this data is as of the end of 2023. We are recording this in January of 2025, so it's a little more than a year old. The top 10 holdings here, to my eye, Ferguson. I recognize Ferguson as a company, and that's it, right? I don't recognize these other companies. But again, if you're betting on some of these smaller cap companies, $2 to $10 billion in market capitalization, increasing in value exponentially, so more so than the C fund, this might be an opportunity for you. Total expense ratio, again, just to cover that, 79 cents for every $1,000 invested, or 7.9 basis points, and it's tracking the Dow Jones U.S. Completion Total Stock Market Index. All right. Now we're going to go to the I fund. The I is the International Stock Index Investment Fund. So this is tracking things in Hong Kong and other parts of the world. So let's jump into the specifics of the International Stock Index Fund. We're going to go straight to performance. This one, not as good, right? America has been doing great things for a long time. We have a massive economy. It's a very dynamic economy, from financials to technology to healthcare. A lot of the things that you see a lot of growth in are headquartered here in the United States. Other parts of the world, a lot of them are still developing, and even those that are developed, you don't have as much of a dynamic economy in them. They are dictated more in a central way, where in the United States it's a lot more dispersed, and there are some positive externalities as a consequence of our free market capitalistic economy operating and growing versus a more centralized economy. And so we're seeing that here in the numbers, right? So year to date, 4.2. That's not very good, because we know we've been in inflationary times. This is barely beating inflation in most years. In other years, it's not, right? Lifetime return is 4.8%. Also, not the best. It's not terrible. It's beating most high yield savings accounts, but it's nowhere near the returns that we're seeing in the S and the C fund. So growth since inception. This fund started at the same time as the S fund, so in 2001. And as you can see, just like in the S fund, there are some dips below the inflation rate here around the same time, and it touches inflation in some other periods in time as the S fund. And then it goes on as we get into the 2010s and beyond to consistently beat inflation by just enough, right? So this fund really, it's not as exciting as the first fund we talked about, the C fund, and also not as exciting as the S fund, to be honest. So where are the companies located that are contributing to this international fund? The companies are located in Japan, in the United Kingdom, in Canada, in France, and India. These are developed countries, and their economies just aren't as dynamic as the United States. And so when you think about Japan right now, it's fairly stagnant in terms of their economy, their growth, their demographics aren't growing to the point where they're able to sell a lot of products and services to their own population. And so they have to export sales, and then they're competing that much more with the United States and other countries that have companies in them that provide similar products and services. And so you don't see the ability for Japan to keep up for that reason. Same thing in the United Kingdom. Their demographics aren't as good as the United States. And our demographics aren't perfect, but everything being relative, we're able to compete very aggressively with other developed nations throughout the world. And they have about 300 companies that are contributing to this international fund. As we scroll down here, you see some smaller but also developed countries like Italy and Spain and Brazil and Saudi Arabia also contributing here. And I'm trying to see if Hong Kong made the list or China. And I am not seeing China on here. Okay, so there are several Asian countries, but China is not one of them. So there you go. Israel, with 103 companies headquartered in Israel, is contributing 0.7% to this international fund. So this is, interesting things to look at, think about, not just from a return perspective, but from a values perspective, right? If you're invested in the international fund, what countries are contributing to this fund? I don't see Russia. I don't see China. I see more or less either allies or folks that don't have a stake in any geopolitical issues right now contributing to the international fund. So that's really interesting to see. Moving on to fees. So we have a net administrative expense ratio of 48 cents for every $1,000 invested, similar to the S and the C fund. The investment expense ratio is 60 cents, and the total expense ratio is 54 cents for every $1,000 invested. So a little bit better than the S fund. But again, when you look at the returns for this fund versus the S fund and versus the C fund, it's night and day, honestly, right? 4.27% year-to-date return is a far cry from the 17% that we saw on the S fund and the 25% that we saw on the C fund. In summary, these are some of the top 10 holdings that you're going to find in the I fund. These are some fairly popular companies here. Nestle, right? It's a big company. Samsung, that's a big company. Shell, AstraZeneca, the pharmaceutical company. SAP, it's a huge company coming out of Germany. So, yeah, some of these companies are really, really big, very, very popular. The products and services are used by people throughout the world, but you're still not seeing that reflected in their return as a consequence of all the other things that I talked about earlier. Total assets in this, $78 billion. That it pales in comparison to the C fund and the I fund. The benchmark is the EAFE, which is Europe, Africa Index, right? And East Asia, index. And there it is. That concludes the explanation of the SC&I fund within the Thrift Savings Plan. You can see the comparison here a lot more clearly in this chart. 25%, 17%, 4%. The year return, the last year return, the last 3 years, last 10 years, lifetime, those seem to track. And then the risks involved. The individual fund with the highest return has the lowest risk. And then the return with the middle return, right? The S fund has a medium high. And then the return with the lowest number, the I fund, has the highest risk. So I know a lot of people out there are thinking, if these are the numbers and these are the facts, at what point should I be investing in the international fund? I would argue, unless you really believe that the US economy is heading on the downslope and some of the other countries that you saw represented in the I fund have an upward trajectory, there isn't a reason to invest heavily in the international fund. You can use it to hedge against growth or the lack thereof in the S and the C fund, but you definitely should not be contributing a large percentage of your dollars into the I fund based on the numbers that we saw here today. All right, so that concludes my explanation on the SC&I fund. I hope this was helpful. If it was, please like the video, subscribe, hit the notification bell as we continue to produce content on the Thrift Savings Plan, on VA home loans, certificate of eligibility for education benefits, all the things pertaining to members of the military. My name is Cashin Nunez, and as always, I'm reminding you to secure real education, invest in performing assets, get rid of bad debt, and provide oversight to those assets.
The RINO Invest and Cash In with Cashin YouTube channels are hosted by Cashin Nunez. Cashin Nunez is a financial planner with RINO Invest Wealth Management. RINO Invest Wealth Management is a registered investment advisory firm regulated by the Securities Division of the State of Georgia in accordance and compliance with the securities laws and regulations. RINO Invest Wealth Management does not render or offer to render personalized investment or tax advice through the RINO Invest and Cash In with Cash In YouTube channels. The information provided is for informational purposes only, may not be suitable for all investors, and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.